Smart Silver Stacker here. Hope you're doing well. Today, we'll be discussing the spot price of gold and silver because it's probably not exactly what you think. And the reason I say that is because this topic seems to be, at least based on the feedback I've gotten on the comments of this channel and just in my conversations with other stackers, a source of a considerable amount of misconceptions about the price of gold and silver, how this spot price number is arrived at. And if you tuned into the live stream I did a couple of days ago, I did touch on this for a few minutes. So we are going to revisit this because I think it's an important enough topic to warrant its own video. And don't worry, if you saw that one, I'm going to be getting into some additional information on this topic in today's video. Now, if you're joining, please say hi in the chat. Appreciate everybody who tunes in. This is a live stream, of course. So if you have any questions, anything you'd like me to comment on this topic specifically, let me know. And please do smash that like button, help get this information out there. This is an important one, folks, because the spot price of gold and silver, the way they determine it is with paper contracts. I see Shows Hugino in the comments mentioning paper contracts. And it's a bizarre situation in which the price of an underlying commodity, being gold or silver in this case, is being set, it's being determined by paper derivatives of those commodities. And this situation that we find ourselves in with the precious metals markets, it's one that, not only can lead to some confusion as to what the actual price of an ounce of gold is or an ounce of silver, but it's also one which allows a significant amount of price manipulation in the precious metals markets. I mean, this really is the problem that all these paper contracts are floating around out there. Now, if you're thinking of stacking some precious metals, the physical kind, not the paper kind, by the way, make sure you check out today's video sponsor, sdbullion.com. Right now, they're giving away a 2023 box of Silver Eagles. That's 500 coins. You can visit sdbullion.com/sweepstakes to sign up. So make sure you check them out. Now, one of the reasons why I believe there is a lot of confusion surrounding this topic of the spot price of gold and silver is that when you look at different sites, sometimes you get different prices. This is kind of the portion I covered in the previous live stream, but don't worry, we're going to get to some new and fresh stuff as well. But for those who didn't catch that last one, I do want to mention this because this is very important and it can be kind of confusing, especially if you're a new stacker or even a seasoned stacker. This can get kind of weird where you look at different sites and you get different prices for gold or for silver. So this is the Google finance page for a gold continuous contract. And you notice they say they get this price from the COMEX. That's a major commodities exchange here in the US. Then if we go to the Yahoo Finance page, get a completely different number for the price of gold. Significantly higher, actually, almost $30 higher price of gold that's being quoted on Yahoo Finance. And you can notice that it also says it's from the COMEX. So, I mean, what gives? That's weird, right? Well, the reason that you see different prices quoted on different sites is that there's more than one type of futures contract. And again, the spot price of gold, it's not the price of an ounce of gold. It's the price of a paper ounce of gold that's part of a futures contract traded on a commodities exchange like the COMEX, but not necessarily exclusive to the COMEX. I mean, there's multiple commodities exchanges, and we'll be demonstrating some differences in prices that they have here in just a moment. But first, let's just look at the CME Group website. So this is the COMEX gold futures quotes, and this shows the price of the different futures contracts. You can see August 2023 $1,913. You go to the September contract, $1,920. October, $1,929. We get to December, you see $1,947. So very likely that is related to the quote that was being displayed on Yahoo Finance. And then you can see, I mean, we've got many months forward. You can see different prices. Looks like the markets are anticipating the price of gold will be rising. Futures contracts further out are higher. And the reason that you might pick one particular month or the other to quote in terms of a futures contract can be kind of hard to determine. But one thing you would look at would be the volume. So we can see there's a volume tab here, and current month, August, got 451 contracts. September, 719. October, okay, there's some increase in trading, 4,671. So maybe some sites will quote that one because it's a closer month and it has higher volume. But then look at the volume for December. 130,739 contracts. I mean, it's a notable difference. So that clearly is the most widely traded, the most liquid futures contract for gold at the moment. And I suspect that that is why Yahoo Finance is quoting that one, because they want to pick the one with the highest volume. Now, I'm not going to look at this CME group endlessly, so don't worry if you're getting a little bored with this, but this is for silver. I just wanted to point out it's the same story. You've got, different prices for different months, futures contracts. And so you might see some of these different prices quoted. Now, this is a problem that the price of the precious metals, the spot price, that's what we always hear quoted when you talk about the price of the metals, is determined by these paper contracts. And part of the reason is because there's a lot more paper contracts that get traded than there is underlying physical metal. And so it's hard to say that that's actually a real price. And that's part of the reason that while a real ounce of silver, like this American Silver Eagle coin, does have some relationship and some correlation to the paper spot price, it's certainly not a one-to-one sort of thing. And this is why sometimes, for example, in March earlier this year, when there's a lot of market uncertainty and people are looking for the safety and the lack of counterparty risk that the precious metals offer, the physical metals themselves, that's why you start to see the premiums on metal shoot up way above the spot price. So you might see little action in the spot price, or you might even see the spot price fall down, but at the same time you might see a 1 ounce round of silver increasing in value, and that's because they're not the same thing. A lot of times people freak out and they complain during these kind of periods of uncertainty where you see rising premiums that dealers like SD Bullion and your local coin shops and various other metals dealers are getting greedy. But the real thing is that those paper markets, they're not representative of the real metal. I mean, yes, they are correlated. And look, it's not entirely untrue to say that you can't get physical metal for the spot price, because you can go on the COMEX, for example, and if you buy a futures contract, it represents 5,000 ounces of silver, and you can take delivery of that contract, but you're not going to get, nice 1 ounce coins. This is what you're going to get. You're going to get something like these COMEX bars. I mean, they have them on SD Bullion. They sell them. You can buy them. They're a little bit non-uniform. You can see the SD Bullion has individual listings for each bar because, you get one that's 1,000 ounces, one that's 1,005, one that's 988. And this is what they're going to give you. They're just going to give you 5 of these bars if you settle a futures contract at the COMEX. So, not nearly as neat and convenient as a nice 1 ounce coin. I mean, and that is why you pay a premium when you buy this sort of thing over the spot price, because the spot price is the price of an ounce of silver when you buy 5 giant 1,000 ounce bars. And here's another thing about these paper industries, or these paper markets rather, they don't settle most of these contracts. I mean, most of the time it is just paper trading hands, and if a contract does get closed out, it gets settled for dollars, for fiat currency. And again, this is a large part of why we see manipulation in the precious metals markets. We're going to get into that in just a moment. We'll talk about some examples of that and how we can see price suppression in gold and silver as a result of this pricing mechanism with the futures contracts. But first, I also just want to point out that, again, it's not just the CME. You've got other commodities exchanges. This is the LBMA, the London Bullion Market Association, I think. This is their precious metals prices, and they have their own price, $1,920 for gold for yesterday's price. So again, this just adds a little bit more confusion, a little bit more paper floating around out there with different prices, and so you might not even see the CME price quoted. You might see the LBMA price quoted, and this is similar to other commodities. With oil, for example, you've got WTI, which is West Texas Intermediate. That's like a U.S. price quote. Then you got Brent, which is UK and North Sea oil. And then you have other markets too, like you've got the Urals crude market. That's like the price of Russian oil. So this is not an isolated thing to gold and silver, that there would be different spot prices out there. And so that's why, when you see a spot price posted somewhere, say on a bullion dealer website, and then you go to another site and they have a different price quoted, no one's trying to get one over on you. No one's trying to defraud you or quote a higher price of the metals. It's just that, there's different contracts that they may be quoting. And some people may pick the one with the highest volume. Some people might pick the nearest month. Let's see, I got some questions here in the chat. Should I buy from secondary market if it's for a lower premium? Well, maybe. You do have to be very careful with the secondary market. You don't want to buy any counterfeit products. If you're buying bars, for example, you might want to, hit them up with a tester of some sort. If you're buying from a reputable dealer on the secondary market, like secondhand bullion, that's probably okay as long as they're assaying and testing everything. But if you're just going out there and buying from third-party individuals who you haven't really vetted significantly, be wary, because there are certainly counterfeits out there of all makes and models. Just check out wish.com or alibaba.com and search around for gold and silver bullion, and you can see there's all sorts of fake Chinese bullion that you can import. None of it is marked as such. So that stuff is out there. So just be careful. If it seems like it's too good to be true, it probably is. And then this is another commodities exchange. You've got the Shanghai Gold Exchange. And these prices are not even quoted in US dollars. They're quoted in Chinese yuan. That price right there for AU 99.99, I'm assuming that's their quote for 99.99 pure gold. And you can see the last price, 455.5. I believe this is for a gram of gold, and that comes out to about $62 when you convert yuan to dollars. So again, just to point out, there's multiple markets around the world, and in the Shanghai Gold Exchange, for example, they don't even denominate the price in US dollars. It's denominated in yuan. So spot prices are kind of a tricky thing. And, at the end of the day, the real price of an ounce of gold or an ounce of silver is what you can pay for it or what you can sell it for. I mean, just like anything else, it's what is someone willing to pay for it? What is someone willing to sell it to you for? That's the most important number you can find. And, different products have supply and demand associated with them. For example, this is like a modern bullion coin, this gold Britannia, and an ounce of gold in this form is going to be cheaper than an ounce of gold, say, in the form of old US pre-1933 gold, because this stuff has some collectability and a scarcer supply, and they're not making it anymore. And the same thing goes with junk silver and generic rounds, like pre-1964 or 1964 and earlier. 90% US silver coinage is going to have a higher premium associated with it than a generic 1 ounce round. And then stuff from the US Mint, like this Silver Eagle, the US Mint, if they get their act together and make enough of these things, you would be able to get these at a reasonable price. But right now, the premiums are super high because the Mint won't make enough to meet demand. So all of these individual, retail bullion products are going to have their own market. And again, they're related to the spot price, but they're not 100% correlated. And occasionally you see divergences between physical and paper metal. Travel Tim, okay, this is a good question. He says, why do you pay premiums when you buy, but you don't get them back when you sell? Well, first of all, sometimes you do. If you remember in March, SD Bullion, I just know they have quotable prices that you can find on their buyback page. They were offering over spot for even large silver bars. For Silver Eagles, I think they were paying something like $9.99 over spot when you sold them back to them. So sometimes you do get the premium back, but here's the real reason. It's because with any market maker, like a bullion dealer or a local coin shop, I mean, they're going to have a spread on the product, right? So when they sell a 10-ounce silver bar, for example, maybe they sell it for $1 over spot per ounce, or nowadays probably closer to $2 or $3 over spot. And then when they buy it back, maybe they pay spot. And that thin margin is how they keep their doors open. They have staff they have to pay. They've got electric bill. They've got rent. They've got all these expenses. And, they're operating a business. They're selling to the retail consumer who is sort of at the bottom of the supply chain, the end of the supply chain, and products at the end of the supply chain are always going to have a little bit more of a premium associated with them, but that's just how it goes when you're buying physical metal. That's why if what you're looking to do is say trade in and out of the metal and capture a profit from short-term price moves, you probably don't want to buy physical metal because what you want to get is like an ETF. Either the SLV or the PSLV or the GLD, something you can trade in and out of very easily, very quickly without premiums, something that's very liquid. But when you're looking for insurance against the collapse of the dollar, SLV and PSLV and GLD, that's not where I want to have my money. I want to have real physical, tangible money. When you're buying insurance against the collapse of the banking system or against hyperinflation, these paper assets, they're just not going to cut it. And that is why we stack physical metal. Like, does in a perfect world in which you have a free market economy and a currency that's not being debased, does stacking precious metals make a lot of sense? Well, maybe not, but that's not the world we live in. And so if you want to have these kind of non-correlated assets outside of the financial system, you have to be willing to pay that little bit of a premium. I mean, that's just how I look at it. I pay the premium too, just like everybody else. And maybe I'll get that premium back when I sell. Maybe I won't. Sometimes you do. And I anticipate that, when a real currency crisis occurs, when the price of the precious metals really spikes up, when it becomes clear what's going on in the economy. I'm not going to get into that in today's video. There's plenty of content on this channel in which I discuss that. But when that happens, I think that you'll probably get those premiums back and then some if you decide to sell at that point. Or maybe you just hold your metal and let it, carry some wealth over into the next economic paradigm, whatever that ends up being. But this paper market, this spot price determined by a derivative of the precious metals, this is really a significant contributor to the manipulation that we see in the precious metals market. It was only a couple of years ago, people have kind of a short memory, but JP Morgan had to pay close to $1 billion in fines for manipulating the precious metals and treasury market. They were spoofing the gold market, which means they were creating all of these trades in the paper market that didn't actually get fulfilled. So they were controlling price action. And why would you do that? Well, I mean, I don't know why JP Morgan was specifically manipulating the price of the metals, but one thing you might do is you might drive the paper price down artificially with, say, naked short positions that don't ever actually get filled, like a bunch of orders that don't get filled that spook the market and drive the metal market down. And then maybe you go in and you buy physical metal and you get it at a nice discount. When you're operating on a huge scale, like a place like JP Morgan is, you drive the spot price down a couple of bucks, it can make a big difference in the price that you're getting on your physical metal. Now, I don't know that that's what they did. I'm not saying it is, but it's just one example of how you might benefit from manipulating the price of the precious metals. I mean, I'm not a real scheming individual. I've never been involved in any, Ponzi schemes or spoofing or anything. So I'm sure that more devious-minded individuals out there can come up with all sorts of ways to profit from manipulating the price of the precious metals. But it does happen. I mean, obviously. And you think about, that's the time they got caught and they had to pay a fine. How much goes on behind closed doors that we're not aware of? How much manipulation is there that never sees the light of day? Because JP Morgan, they pay $920 million in fines. They probably made more than that in profit from their scheme. So why not just rinse and repeat? I mean, I do think that one of their traders was convicted of spoofing, but just some mid-level, low-level guy. Nobody in the senior management was seeing the inside of a jail or anything for that incident. And so why not rinse and repeat? It's basically just sanctioned behavior. But listen, we can talk about manipulation of precious metals all day. I say, please suppress the price of gold and silver. Drive them down as low as you want, JP Morgan, because, if they do that, probably what they're doing is going in and buying physical, and I get to do the same thing if they drive the price down artificially low. And here's the thing about price manipulation. I mean, maybe you can manipulate the price of something like, say, Bitcoin, and you could do that in perpetuity, and you could just, paint the tape and naked short the thing and control the price and scheme and do all the things you wanted, and you wouldn't ever be able to see the end of it. But with something like gold, or especially silver, I mean, silver, I think, is really the Achilles heel of the paper manipulators. And the reason is because, you can't build a solar panel with a futures contract. You cannot build a cell phone with a share of the SLV. You need the real physical metal to accomplish that. And lots of silver gets consumed. In fact, last year we had a major deficit in silver, meaning a lot more was consumed than was being produced. I think it was to the tune of nearly a quarter billion ounces, somewhere just under 250 million ounces more got consumed than got produced last year. So, I think that that is likely a symptom of price manipulation to the downside, because the production, if the price was allowed to rise, you would see more silver production. But because the price has been kept low for so long, you don't see that investment in new mining. And the investment in industry, which consumes silver, continues to march along. In fact, it's probably encouraged by the artificially low price of silver because, if the price of silver was higher, maybe folks looking to build solar panels would look for alternatives or they'd, try to economize more. But if the price is so cheap, and I mean, silver is just ridiculously cheap, it's something like, under 20% of its inflation adjusted all time high if you go back to the 1980 high. So, industries that otherwise might be incentivized to economize and use less silver aren't. And that's a recipe for shortages. And once shortages occur, you're going to see the price explode. Even if these paper markets stay trading low, what you'll see is just the premiums explode and the physical market and the paper markets will have a divergence. And I think that's what we're headed for. I mean, I could be mistaken about that. You don't know what you don't know, but it seems like that is the case. And then when you look at just how much paper silver, for example, is traded relative to the amount of physical that is around, it kind of becomes clear that that's the track we're on. Now, this is the latest numbers from Mike Say 98 on Twitter. He always posts these great infographics regarding the COMEX vault inventories, and you can see that right now the open interest, that's the number of outstanding contracts on the COMEX for silver, 137,489. Those represent 5,000 ounces each. That comes out to be, I think, about 680 million ounces if you do the math. And then look at their vault totals here. They've got 30 million and change of registered silver. Now that's the stuff that's like immediately available for delivery. Like they can give it to you today if you settle a contract, or maybe not today, but they can give it to you one way or another. And then, and mind you, that's 30 million ounces against 680 million ounces outstanding in contracts. Then you got the eligible silver, 250 million basically, and that gives you a grand total of 280 million ounces. So that already seems kind of slim compared to the 680 million outstanding contracts, or 680 million ounces worth of outstanding contracts. So they've got less than half. But then, look at this. This is a document that was posted here by James Anderson. Shout out to James. Had him on the channel before. He always does great work. He posted this a while ago, but this is a document from the CME group. He posted that on Twitter. This is the important part. So the CME group was doing surveys to determine how much of their silver actually was available for delivery. And again, you can see the URL here. I'll put it on screen so you guys can check this out if you want. This is posted on the CFTC. It's also on the CME Group website. And they did this survey and they were trying to determine how much of that eligible silver was wrapped up in long-term investments. Like it was sitting in their warehouse, but it was owned by somebody and it was allocated to them. So basically it's not available to deliver to anybody. And according to them, they couldn't figure out exactly how much it was, but based on these surveys, they made the determination to discount from its estimate of deliverable supply 50% of its reported eligible silver. So when they tell you that they have 250 million ounces of eligible silver, that's actually, let's call it 125 million ounces of actual deliverable silver. So if you do the math, then you get 125 million ounces of eligible silver, 30 million ounces of registered silver. What does that give you? About 155 million ounces of silver against contracts outstanding for 680 million. So, it's just an incredible amount of silver that gets traded relative to the amount of actual underlying metal. And then, I think we all saw those reports from earlier this year where I think it was JP Morgan had a warehouse full of what they thought was nickel, and it turned out to just be full of rocks. So, 150 million ounces of something in their warehouses, but is it silver? I don't know. I mean, do you trust them? I wouldn't want to hold futures contracts. It's like a game of musical shares, you know? Uh, when the day comes when there's a real crisis and everybody wants to get their silver, the safe haven asset to get us out of whatever the next massive financial crisis is, whether it be a sovereign debt crisis or another banking crisis, there's going to be a rush to the exits, and most of the people are going to be left hanging. Maybe they'll have contracts for 5,000 ounces, and what they end up getting is a partial settlement. Maybe they got 1,000 ounces of silver and then a bunch of worthless fiat currency to make up for the difference. Or maybe some people get to settle and then some people get none at all. I mean, I don't know how it's going to work out, but look, I mean, I would rather hold the physical metal myself, and I'm not too worried if the spot price of a paper futures contract is lower than what I have to pay to get the physical metal. Now, look, I'm not saying pay the outrageous premiums on American Silver Eagles right now, by the way. I'm just kind of talking about silver in general. I'd probably rather right now be buying something like, some generic silver rounds. These are always good. You can get some Buffalo rounds. I think right now SD Bullion has those Cowboy rounds from the Scottsdale Mint. You can get those for $2.49 over spot if they still got that sale going on. I love Scottsdale Mint. So those are the sort of things I'd be looking at. I mean, I'm not trying to pay more premium than I have to, but I do just want to recognize that, the spot price, it's not the price of gold and silver. It's the price of paper. It is the price of paper. So when you want to talk about the price of gold and silver, premiums, that term gets bandied about, but premiums are really the real price. Now, one last thing I want to cover here before we wrap this thing up is if you would ever like to look and see how much precious metals there actually are on some of these exchanges, you can find them. They publish them. This is a page on the CME Group website, NYMEX, COMEX delivery notices and stocks. And they have daily updates on their warehouse inventories. And there's really some interesting information here. One last thing that I want to leave you with, and this is sort of unrelated, but just of note. Here's the information for their gold warehouses, okay? This is all the gold they've got. They tell you all these different warehouses. And then here at the bottom, they tell you the total registered gold, total eligible gold, total combined gold, about 22 million ounces there in change. I want to show you something for platinum because this is one of those things that when you look at it, it's like really kind of shocking. The discrepancies here. And it's one of the reasons I kind of like platinum right now. I do view platinum as a speculative metal, but look at the CME Group's numbers here for platinum. You scroll down to the bottom, some of their warehouses don't have any. Some of them have, 3,000 ounces, a couple thousand ounces. Total platinum ounces on the CME, combined total 175,000 ounces, 175,619.179 to be exact. But look at the discrepancy there between how much gold they're holding versus how much platinum they're holding. And palladium, it's an even crazier number now. I don't even own any palladium. But, when you look at these numbers, it makes you kind of want to think about getting them. Okay, I can't swipe any lower. Let's see. They've got 43,476 ounces of palladium over there at the COMEX. So, an aside, but you might, when you see that, consider getting some platinum because, I mean, it is something where there's just a tremendously low supply. And, it's not financial advice. I'm not telling you what to do. I don't do that on these videos. I'm not a financial advisor in any way, shape, or form. But I do think it's wise to just, sprinkle in a little platinum into the mix when you're doing your stacking there. When you look at those numbers where they got 22 million ounces of gold and, 176,000 ounces of platinum. Someone says platinum is truly scarce, but it's an ugly metal. Yeah, well, these coins, the American Platinum Eagle, not a particularly pretty coin. I will grant you that. I mean, it looks a lot like silver to me from a physical standpoint. It's denser and harder than silver, but I don't know. I mean, I don't. I do like the shiny. Don't get me wrong. I like how this stuff looks. Precious metals are awesome. I think that humans have kind of a built-in radar to recognize gold, silver, even platinum as treasure and as something inherently valuable. But the reason I like stacking, less to do with the shininess and the physical looks of the metal, and a lot more to do with the fact that they're just so massively undervalued right now. And I do believe a time is coming when that situation is going to reverse. And it will likely be at a time when that paper spot price diverges from the price of physical metal, and the spot price kind of ceases to be of any importance whatsoever. I do think that that day will come in the precious metals. When it will be, I don't know. Could be tomorrow, could be 10 years down the road. I'm not sure. when you look at the numbers, it's pretty clear that the path we're on is not sustainable. There's a massive amount of paper precious metals that get traded relative to the real physical thing. We've got a lot of dollars that are being printed, folks. There's a lot of debt here in the U.S. $36.8 trillion dollars, I think, is the latest number. We'll be hitting 37 trillion real soon. And we're on a path to economic pain. No other way to describe it, I don't think. And I think it's important to get prepared. Don't be scared, get prepared. But part of getting prepared is understanding how the pricing mechanism of these things work. And I just really think it's a very important thing for stackers to understand. If you're a new stacker, I hope that this was useful information to you. If you're a seasoned stacker, I hope you enjoyed some of the other content I sprinkled into today's video. If you like this, if you found it helpful, please do give it a big thumbs up down below. I hope you all have a great weekend. Thank you for tuning in. It's always a pleasure. Stay safe and happy stacking, everybody. Smart Silver Stacker, out.